Perfect. So we talked a little bit about all of the changes to QBI, income, and thinking about our relevant pass-through entities. We're going to look now at W-2 wages. This one hasn't really changed all that much, honestly, because they gave us a final revenue procedure, and this actually came out at the same day as the final regulations. And it gave us 3 methods for computing the wages, but they really weren't too crazy different from the original one back in the Notice 2018. So they gave us 3 methods, very similar. So it's just letting you know that in the final regulations, this is how it's been figured for the computing those wages. You get to choose which of the 3 methods you want to use. So a thought that I have too is if you get to choose, a lot of our tax software is definitely trying to make all these changes for us. Can we override it, or how do we go about making this change? You want to make sure that if you wanted to pick one of these methods that it is calculating it right. I know most software says, like a disclaimer, that you need to verify these amounts yourself, the QBI income, the W-2 wages, the property, etc. So if you're looking at this, which method do you want to use? The catch to this and all of it, if you want to use any W-2 wage calculation on there, your W-2 wages have to be properly filed with the Social Security Administration on or before the 60th date after the due date. What that really translates to is if they miss filing on time and they're a little late, you can't use any of those W-2 amounts anywhere on the K-1 or the individual, depending whose return you're preparing, because that's technically disallowed in this calculation. So that's definitely a thing I wanted to point out. You got to have timely filed and correctly filed W-2s. So I would maybe wonder, what about your proof of timely filing? Now, it may be that you've already sent those and you don't have it, but this is something I would definitely log away in the future, because if that portion becomes really important in a calculation, it may come down to being able to prove that it was filed on time in a make it or break it situation for taking that portion in your calculation when you have a W-2 testing that you have to do. So of the 3 methods, method 1 is just called the unmodified box 1 method. It's the simplest method, but there are definitely limits to it. All this does is you take the lesser of your W-2, box 1 or box 5. You take the smaller number. So easy, but there are things that affect that calculation that you may not always want to go with simple, plain and easy unmodified box 1 method that just looks at, which is the smaller number, and I'll give that to you. So more commonly, you may be choosing one of the other 2 methods. Method 2 is called modified box 1 method. It kind of starts at the same idea. It takes box 1 of your W-2, and then it's going to subtract out any wages that aren't subject to federal income tax withholding. So just one example I thought of, what about your supplemental unemployment compensation benefits? They aren't subject to federal income tax withholding. That would be something that you would go ahead and subtract out of there. But then you get to add in your elective deferrals. So these are things that definitely, if you have those deferrals, the unmodified box 1 method wouldn't get the best result, because it's going to reduce your box 1. So in this method, we may have to tweak a little bit for any wages that aren't subject to federal income tax withholding, but then you get to add in anything in your box 12, your codes D, E, F, G, and S, all those deferrals, elective deferrals. The last one is very similar. It's called a tracking wages method, and that means you're tracking only the wages that are subject to federal income tax withholding. So kind of honestly achieving, it seems like a very, very similar result, but you're tracking only those wages, and then you're adding in those elective deferrals. So those are 2 different ways of going about it if you didn't want to use the unmodified box 1, which is where you just go ahead and grab whatever's in box 1 or box 5 as the lesser amount. So 3 different ways we can go about it. And this really, the procedure hasn't changed all that much from the proposed to the final. And that way you have a little bit of clarity in that arena. But if we talk about wages, one of the more common things that comes up is says, okay, this whole wages idea, what can we use or what can't we use? Very clearly, if we say what is not included in wages, are payments to independent contractors. Definitely not wages. So, as we look at planning, we look at what about the possibility if you have someone that it's always been kind of on the line where they really do have employees, but they've always been calling them independent contractors. If they switch them to being regular W-2 employees, then they are included in wages. If they're just plain old independent contractors, they aren't. What are included in wages for this purpose? If you have payments that are made on the employer's behalf for workers that are under their direction and control, but paid by a leasing company or a common paymaster or a management company, someone other than them, if it is structured or executed properly, it actually counts as payroll. So in this case, they did say, okay, well, we understand that that's sometimes the structure. We're going to go ahead and let you count those as your own wages, even though they're paid by that employee leasing company. A recommendation, you may want to have copies of that other company's W-2s, because who knows what kind of additional proof we may have to provide in the future of this, but this is another way that you can count those as wages. That's just a little tidbit on the W-2 wages, but there's so much in, not only the proposed regulations, but the final regulations that deal with this area. Unadjusted basis immediately after acquisition. This definitely had so many questions, and it was a little bit confusing. Now that they've given us final regulations, it's really helped to clarify quite a bit of our questions. So I'm going to keep referring to just UBIA. It's a little bit less to have to say. But what does it include? The original cost of property, capitalized improvements, and not touched by or unreduced by depreciation. Well, we kind of knew that with the original, but we were unclear in what happened with bonus depreciation in Section 179 and any basis reduction for a tax credit. Well, they went ahead and gave us clarity and said, no worry, it doesn't touch any of that. That your bonus depreciation, your Section 179, any basis reduction for tax credits, it doesn't touch it. We're looking for that original cost of the property. A few little tidbits in here. Well, the business must own that property the last day of the tax year. So just kind of think about why would that, be logical? The business would have already had a cutoff, or maybe they've sold that prior to year end, they've recaptured it, they have accounted for the losses and gains, etc. They've already dealt with it. So they have to have the property the last day of the tax year. If not, then it's not going to count in this total for our UBIA. What about the owner? They have to own interest in the business on the last day of the tax year. Kind of a logical test there too. We would say, well, if that wasn't the case, that they didn't own an interest, they probably would have accounted for that change of ownership already prior to the last day of the year. They would have dealt with it. They would have already had some sort of a cutoff date or a change or taken care of it. So it has to be that the business owns it and the owner owns it. And we don't have to reduce it by these other things in here. So original cost of property. As we look more into this topic, it's also determined on the actual date that the property is placed in service, and ends the later of 10 years after it's placed in service, or the last day of a full year in the applicable recovery period. So what does that mean in simple speak? So let's say that you have just a simple piece of property, and that's, 39 years, let's say the building is. The land isn't depreciable, so it doesn't count. So the building, say it's 39 years, but you have something in the building. Well, maybe it's a piece of equipment that's normally 5 years. You get to bump it up to 10 years instead. So that's how long you get to use it for this calculation, is what that's determining. Now, I did mention this just a few seconds ago, but the Section 179 definitely held a lot of previous concerns from us from the original text and then the proposed regulations. We weren't exactly sure what to do with it. Now, if you use Section 179, hey, it doesn't matter, because we have at least the bare minimum 10 years life for these purposes. So we don't have that same worry of concern as far as how Section 179 interplays with it. But you have to think of what the side effect of that is, honestly. I mean, that sounds great on the surface, but if you're using a lot of Section 179, it reduces your income, therefore reduces the deduction all around. So, I mean, it's, we got to kind of test both sides of this as we look at the whole big picture. It's only depreciable property, so I kind of gave you that hint a moment ago. Land is not depreciable, so doesn't count, only the building would. But then we have some things in the final regulation talking about stepped up basis. There is a lot of language in there for that. I'm just going to give you kind of the summary of this. They said, here's what we're going to do for this. There's a lot that was proposed and a lot of questions, but they said in the final regulations, whatever the transferor's original basis, that's going to become the transferee's original basis. That whole stepped up basis thing doesn't really work in the same way as what we're accustomed to for UBIA purposes. And the original holding period too. So here we've got to be a little cautious because we almost may have two completely different schedules going. So again, check your software. See, is it checking and calculating both of those separately? Do you have your UBIA number that is the original basis and original holding period versus maybe what you might be doing for regular depreciation on, the regular tax return? So two different numbers that can affect it. Along a very similar thought wave is what happens with 1031 exchanges and 1033 involuntary conversions. The exchanged UBIA is the transferor's original UBIA of the relinquished property. So we're kind of starting to follow the same theme. Now, they went back and forth a little bit, but this is the final regs version of it. And again, with the relinquished properties placed in service date. The excess basis now is new basis for the boot paid portion for replacement property, and again with the relinquished properties placed in service date. So here again is where we're almost having two separate schedules that we need to track here. To give you an example, let's say, this was also true of the proposed regs, by the way, it said, it had this little term in there, property net of depreciation. They took that out. So the proposed regs, the way we would have gone about it is, let's say your property was $100,000 and you had depreciation on it of 20. We're going to be tracking that for $80,000. Final reg said the original basis and holding period, and it doesn't matter what the depreciation was. So we would use $100,000. And again, two separate schedules because maybe we're tracking those 1031 exchanges differently for other tax reporting purposes, but for UBIA, this is how it's going to work. Is we're going back to, we're looking at the original numbers, whether it's, stepped up basis questions, nope, transfers original basis, 1031 exchanges and 1033 involuntary. We're looking at original is kind of the theme to take home from this. So again, if you are choosing between your proposed or your final regs, it's an all or nothing, but that way you get to see a little bit of the difference just within this area between the proposed and final as well. They are very heavy on the anti-abuse rule, of course. They looked at some of all these different ideas out there and said, oh, there's a pretty high likelihood that some of this is going to be skewed to where abuse may run rampant. So they said, okay, you cannot count property acquired within 60 days of the year end and then disposed of within 120 days without being used in the business more than 45 days. They don't want you just to hurry up and acquire something and then get rid of it just because you're trying to change your QBI deduction. You could possibly overcome that if that was a true circumstance that just happened to occur, as long as you show the purpose wasn't to increase the Section 199A deduction. But they are definitely looking out for abuse in the Section 199A deduction. And as I've mentioned a couple times over in that last one I gave you, is one, depending, I guess, if you're choosing the proposed or final regs, one method is going to have you tracking $80,000 for the calculation, $100,000 instead if you're using finals, and then all the other different ways you have to calculate it. So it is a question certainly to say, do you have to keep separate UBIA schedules? Do you have to keep separate, definitely UBIA schedules when you're looking at possible 1031 exchanges and other types of property. So it's just a thought for you. And does it do that for you? Will yours automatically calculate and track a second basis within those cases? And this isn't simple stuff. This, it has been pretty complex the moment they came out with it. So I certainly sympathize with the software developers having to create all this, quite honestly. But it's for us to at least know what we have to track and what we have to pay attention to. And not everything is just like a click of a button. This is a year where we have to make decisions, and it's kind of uncomfortable for a lot of preparers.